Hi, welcome to PlanStrongerTV. I'm your host, David Holland. Are you tax diversified? Are you financially diversified? You need both. That's what we're going to talk about on the program today with the help of certified financial planner Nancy Anderson. Stay tuned. Welcome back, ladies and gentlemen. So, tax diversification and financial diversification? Yes, we need both. What does that mean? Well, what it means is we want to be financially diversified, of course, and that is something that a lot of people understand. We want to have a proper mix of investments for our particular situation and stage of life. If you're already retired, you're probably going to want to be more conservative than somebody who is just starting their career and investing for the long term. So, now in retirement, you still have a long term, hopefully, but your investing is different. You don't go necessarily with 100% in stocks. You might have a mix of stocks and bonds and other assets or categories. Well, just as you do that to diversify the financial investments, you also want to look at diversifying your taxes. What do I mean by that? Well, different types of accounts are taxed differently. IRAs, Roth IRAs, regular brokerage accounts, cash in the bank, tax-deferred annuities. Some types of investments are tax-free. Roth IRAs, all of those have a different, what we call tax character. And so when we look at those different types of accounts, we want to have a mix of them. Now, in some situations, you can't help but do it one way or other. You know, if all your money's in an IRA because that's how you saved and you did it through your 401k at work, I'd rather you have the money than be diversified and not have it. So it's great that we accumulate. But ideally, if we can help it, and we can take steps to do this, have money in different categories. Why? Because when we get to retirement, we can pull on them in different ways in the right mix so that we keep our taxes low. Sometimes we draw from this account, sometimes we draw from that account, or we draw from all of them, and because some of it's taxable, some of it's not. This is what we want to get to on the program. So I'm excited about it. It's a great idea and concept for you to incorporate into your planning. So stay right there. We'll be right back and dig in. To help us dig deeper into this very important subject of not only tax diversification for your investments, but also have them serve more than one purpose, I've invited Nancy Anderson, a certified financial planner all the way from Salt Lake City, Utah. She has 25 years of experience as a financial planner and is currently a senior financial planner with Key Bank working in the private banking area. She helps business executives, entrepreneurs, professionals plan their financial futures. We'll be digging into this subject and leaning on Nancy's experience as a contributor to Forbes.com in the personal, finance, and retirement planning area. Welcome, Nancy.
Thanks for having me.
Glad to have you with us.
I'm excited to be here.
Yeah, it's very good to have you with us. This is such an important subject for so many people who are trying to plan their financial futures. Either they're planning for retirement or they're already retired. They want to know that they're making the most of their money. You know, there's only so many dollars to go, right?
There's so many dollars to go around, David. Well, the problem is people are really frustrated because they have competing goals.
Yes.
So you want to save for retirement, you need an emergency fund, you want to send your kid to college, and then you want to take a vacation now and then, right?
Imagine that.
Yeah, imagine that. So how can you do everything? That's a real problem for people today.
Well, so, you know, people they hear all these competing objectives and they hear you should do this, you should do that. You know, in the financial world, let's be honest, there's a lot of dogma and propaganda about you have to save every nickel and take tuna fish for lunch every day and that you never get to do anything. And so I love your idea, and I've read a lot about your work on Forbes.com, that you can actually have your accounts serve more than one purpose so that you can save for retirement, but if something comes up, you've got those emergency funds.
We have to be practical. Like we were saying, there's not enough money to go around. So we have to be practical, because it doesn't work to have, oh, I need 6 to 9 months of an emergency fund, and I need to save for retirement, and I need a vacation fund, and pay off debt, buy a house. It just doesn't work. So I think what's a practical way to handle that is to have your accounts do double duty. Have them work 2 different jobs. So here's an example.
Okay.
A good friend of mine who's one of my clients, her name is Barb, and she's a single professional. She makes about $120,000 a year, which seems great, except
money.
she has a mortgage. She has a daughter in college, and like I said, she wants to visit that daughter when she's in college. So she has about 4 months of emergency fund, which is, in her case, about $40,000. When I sat down with her, I had her, I looked at everything. I said, like, throw all your puzzle pieces on the table.
Yeah.
So we looked at, she's got a Roth, she's got a 401k, she's got her savings. And what we found was some of those accounts could do double duty to actually get her to at least 6 months by just looking at one account.
Okay. That's good. Well, so a lot of people who are watching this program are going to think, well, I've got a Roth, or I've got some cash in the bank, and how do they know how much to have on hand for emergencies? I know there's these rules of thumb, but shouldn't they really look at their individual situation to determine how much cash to have on hand so that they could invest and do some of these other things?
Well, financial planners, which we are both, right? So we generally recommend 6 to 9 months of the emergency fund of your, some say expenses, some say income. But if you have, in general, 6 months is the rule of thumb.
Okay.
But yes, so you may want to make some changes based on your situation. If someone works for, say, the fire department, or a job that they've been there for many years and it's very, very safe, they could go a little bit on the shorter end and maybe do less than 6.
Okay, so you're kind of protecting against losing your job, but also for financial emergencies that might come up. The refrigerator breaks, or the air conditioner breaks, or you're in an accident and there's not enough money from the insurance company to buy the car or fix the car. So it's preparing for those things. But the other thing is, people have these other accounts like a Roth IRA that also can serve as like a backup account as well, right?
Most definitely, and I don't think people realize that. So that's exactly what Barb did. So she had a Roth IRA. So most people, maybe a lot of people don't know that you can actually take the principal out of your Roth IRA without a penalty. A lot of people don't realize that.
Sure.
I'm not saying do it.
Right,
I'm saying that could get you to help pad your emergency fund. So because Barb had the Roth, that got her to the 6-month emergency fund. So it's important to have money in savings, but then you can also maybe use your Roth, and then another account that people don't realize that they can use indirectly as an emergency fund is a health savings account. Okay,
you got to share about this, because I know you wrote about this on your blog. How do you use a health savings account to do stuff besides pay for health-related?
Right. I know Congress says you have to use it for health-related things, Nancy.
Right.
So
we're not going to get in trouble, are we?
We're not in trouble. Okay. So it's indirectly.
Okay.
So so for 2017, for this year, you can save $3,400 into a health savings account, triple tax benefit. It's pre-tax.
Okay.
Right? Then it's tax deferred along the way. And then when you take it out, if you use it for qualified medical expenses, it's tax-free. There's nothing like it. So if you don't have one, look into it. But how can you use it for an emergency fund?
Right.
The first thing you would do is don't use it, just let it grow.
Okay. So kind of hoard it. Save it as, this backup.
Are we telling people to be hoarders,
yes.
David?
Yes, we are. A little bit, just a little bit.
So, yes, hoard it. So if you can afford to pay your own out-of-pocket medical expenses, then pay them, but save your receipts.
Okay.
So the IRS allows you to go back a year, 2, forever.
That's remarkable.
And reimburse yourself. So if let's say there's an emergency and a relative is sick and you need to buy a plane ticket, you can't buy the plane ticket directly out of your HSA. The plane ticket won't fly.
Okay, I get it. I get it.
The IRS got it? Okay, sorry. Anyway.
That's okay.
But you could do that indirectly. You could buy the ticket, whatever the emergency is, and reimburse yourself. Because the $3,400, you can just let that build. You can hoard it.
Okay, I'm with you. So you kind of have your HSA as a backup investment account, and you're hoping not to need it, but then if you do, you've got the receipts where you can go in and get that money out tax-free to take care of the emergency. I love that.
Yeah, so that could get, in our case of Barb, right? The Roth IRA got her to 6 months. The health savings account might get her to 9 months. She might actually have the 9 months in her emergency fund, and she didn't even realize it.
That's excellent. Well, wait, there's more, okay, if we act now. I mean, there's one more idea here is also have your investment account, your brokerage account. And this will get into some of the conversation I want to have with you about diversification from a tax standpoint, is you have your brokerage account. A lot of people not only invest in their 401k or IRAs and their Roth, but they also will put money into a brokerage account, which is what we call in the industry a non-qualified account.
Right,
And that money
Brokerage
goes
account.
in, you've already paid tax on it, and it's working, and we hope that we can let that money work long-term for our retirement. But that money, too, can also be a backup in the case of an emergency and can be a lot cheaper to get to than, for example, trying to get money out of your 401k or an IRA.
Exactly, and I think a lot of people aren't using those as retirement accounts these days. Back in the day, we used to invest in the 401k and then also do an outside brokerage account. But the financial planner's dream, right, is have someone the day they retire, they come in, they lay all those puzzle pieces on the table, and some of them are capital gains tax treatment, like this brokerage account.
Right.
Some had been pre-tax, and then they're taxable when they take it out. Some people have the Roth, where it's then tax-free. So it's really nice at retirement to have the ability to choose from different types of tax treatment for your income stream.
I love that.
Yeah.
I love that because we don't know what the future is going to bring in terms of taxation, okay? So we may have periods of time when people are in retirement or entering retirement where we could have higher taxes, lower taxes. Capital gains are taxed one way now, they may tax differently later. So when you have these puzzle pieces you describe, and it is in a perfect world, that is what we all dream of as financial planners, is to have all those pieces. So, but if you've got all of those, as you are saving for retirement and when you arrive at retirement, you can then be in control. You can be master of your own, future and pick these investments or pull on them in a way that keeps your taxes lower.
Right. I think what the viewers can do is to take a look at their accounts and how they're going to be taxed when they take them out. A lot of times we just think about how they're taxed when we put it in.
Good point.
Save taxes today, which is great.
Sure.
Have no problem with that. We love saving taxes. But look at how are they taxed when you take them out, and are you tax diversified?
Yeah.
And you will thank yourself later.
I agree. Your future self will thank you.
Your future self,
well, you've got to think of it while you're putting money away, but for people who are already retired, okay, look at where you are. You have an IRA, you've got a 401k, do you have a Roth account? You have to have earned income to make a Roth contribution, but to make a Roth conversion, to take an IRA, 401k, as you know, Nancy, we don't have to have earned income. We can convert it. So one of the strategies to kind of build toward this multifaceted financial plan is to convert those accounts that haven't been taxed yet into Roth IRAs, some each year. You don't have to do it all at once. In fact, you probably don't want to because you'll get hit with a big tax bill.
Oh, right, yeah, you wouldn't want to do it all at once. The other thing about the Roth conversion, so I agree with you that the Roth conversion can be a great way to diversify your taxable income in retirement. The other thing is that something about the conversion that people might not realize is you have like a look back period. So you can convert it and then you think, oh shoot, I made a mistake and I didn't really want to convert it, or I had
kind of a do-over, like a mulligan.
Yeah, so you can do that all the way up until when you file your taxes the following year.
That's excellent.
Why not do a Roth conversion?
And then see where you are. But having an IRA, a Roth, these different, your regular brokerage account, the non-qualified account we talked about, you have all those, then you have a nice hedge against what may come. And the other part of it, and this is why, of course, you and I do what we do with the financial planning, is this is all very multidimensional. It's all interrelated. So not only do you have that tax flexibility, but what about if the market is experiencing what we know to be a regular occurrence, a pullback or a full-blown bear market, and it's not a good time to pull money out of that investment account? We can flip over and pull more from your cash or that brokerage account, maybe that's invested more conservatively. So we've got two things we can work with. We've got the taxes and the wisdom of where to pull from for not recognizing any losses.
I think sometimes we're accused, financial planners are accused of making things complicated, right?
Well, fair
But when
enough.
you think about what you're talking about, there's a huge advantage for having a little bit of complexity at the other end, because then you do have the ability, I keep going back to the puzzle pieces, right? But you have the ability to choose in retirement, whether it's a market fluctuation, whether it's a few years where you have high taxes. Maybe you're selling a property and you have recapture of depreciation, or capital gains or something like that. Or you have stock options, and in that year that you exercise them, then you have high taxes. Wouldn't it be nice to have done a Roth conversion, and then you figure, oh, well, I can take tax-free income this year. So I think it makes a lot of sense to do that, and adding a layer or two of complexity can add a huge benefit in the long run.
Well, it's important for the viewers to know that adding complexity doesn't mean it has to be more complicated. And this is, of course, what financial planners do. You know, it's building an overall plan that puts these pieces together. And we can't leave out a very important part of every financial plan for most Americans, and that's Social Security. You know, these ideas about these different accounts you have and how you draw on them, all of that plays into the decision about Social Security. And so you may decide to take it early, you may decide to take it late, but we weave all these things together and they all work in concert. And so that's why it does seem more complex, but ever so important to have all that factored in. Don't you agree?
Well, I agree, and I don't mean to toot our profession's horn. I guess I do, but I think that's why people really need to work with a planner, and that you can take the different income streams and make them, simplify
Weave it together.
Yeah, weave it together. Yeah.
Well, and I say a lot of times that, buying a mutual fund or putting money into an annuity, that is not a financial plan, okay?
Right,
I mean, yes, you go and find good mutual funds that are economical, find the right vehicles for you, but when you do that, you have to still put them all together. They, it's a little bit like saying, you know what, I like music and I'd like to have listen to various instruments. Well, fine, violin or the trombone or the piano, but bringing them together in a symphony, you've got to coordinate. Of course, we act as conductors. We bring that together, and you get the most out of these financial investments and products by pulling together and see all these pieces work together. And I know you've done this for a long time, Nancy, so that I'm sure you've seen the difference between people having these things work together and not.
Well, I would say the analogy would be trying to get me decorating my own home, right? So I can look on Pinterest and I can put some pillows together, but clearly when I have a friend who is a decorator and I hired her to do my living room, I was like, oh, now I get it. All of the, similar to the orchestra, but some of the ladies might be able to understand if you're color challenged like I am. But what a difference having a decorator put the right pieces in the right place and the right colors together brought the home from something nice to something that was just super cozy and wonderful. And the same kind of thing that's what we try to do with financial planning. And that's why we're talking about these little accounts, like well, not little, but like a Roth or the HSA or those kinds of things. When you get them all working together for your goals, it can make a huge difference for your future.
Yeah, it's easy to say, well, that's only this much money. It's not that much, or that's not very much. I shouldn't bother. Bother, ladies and gentlemen. Do this and use these different pieces for your plan. It's never too late to do the right thing with your money. It's important to take advantage of every tax benefit you can. Nobody's going to give it to you, right? You've got to seek it and you've got to get it yourself. But doing this, if you want to convert some of your IRA each year to a Roth, or you want to, like Nancy suggested, have the HSA, that health savings account, and you want to let that grow and then have it as a backup plan. I love this. I love this, being able to pull it together. Final ideas? Any other suggestions you have?
Keep some of the money you make.
Yes.
So we talked about putting it away, hoarding, which I think is great, like the hoarding plan. But keep some of the money that you make. Be a squirrel, like hide those acorns in different accounts. That's it.
And if you do that, don't be afraid to spend a little bit of your money. You can't take it with you. So there's a balance act between having some money that you're spending and money you've saved. And you want to have that flexibility. These are very, very important things to do. Nancy, I'd like to thank you for being with us today.
Thanks for having me.
You're very
Pleasure.
welcome. All right, it's time for your questions. So this next one is a great question. It's a little long, so I want to read it to you, but I picked it because it really captures what a lot of people are thinking right now. So let me share you what Sharon asked me to answer on the program. This is just a general type question from us baby boomers. rule of thumb was always to decrease stock holdings and increase safer investments as you get closer to retirement. I am not following this advice and believe it is foolish to not take advantage of today's market. I have two questions. Do you think this advice no longer holds true? And two, do you think this market is unusual historically speaking? Great questions. Wow. I'm going to break that in a couple pieces. Okay, first of all, conventional wisdom or rules of thumb, you know, there's a lot of that out there, and I think a lot of it is good, it's well intended. Rules of thumb are a good place to start, not finish. So, yes, generally speaking, as we get older, as we get into retirement or approach retirement, sure, we want to be more cautious, careful, think about needing that money for income, and look at it a little differently than we would have when we were still in the workforce. Now, the other thing, though, to keep in mind is the reason for that rule of thumb or that conventional thinking is that you're going to need the money. So you always have to think about your investing this way. You always have to remember that we can have another 2008 anytime. And if you recall, it's not that long ago that we had a 40% drop, roughly, in the overall stock market. So the question is, can I sustain that? Or said another way, can I draw my retirement income from another source while I wait for the market to recover? If we go back further to 2000 to 2002, the stock market went through a 3-year drop, cumulative almost 50%. Do you have something else to draw on? Are there sufficient other sources of income, pension, Social Security, other sources that would allow you not to have to draw on that investment account? If the answer is no, or if the answer is, well, but when the market goes down, I'll just take my money out. I'll just get it out when it starts going out. That's difficult to do. It's highly emotional, and it's very difficult to make that timing decision, especially when you're in the thick of it. I know. I've seen people go through it. I went through both those periods advising clients. So the better thing or better approach, and this is to the question of does this still hold true, is I think it's better to plan it out and have some of your money in the market, not all. Now, really what I'm speaking to is being prepared for what may come, and we just don't know. You know, if we look back over the last 100 years, market corrections are a routine thing. They are not unusual. They happen about every year or so. Looking back historically, a market correction is a drop of 10% or more from a previous high. So it happens, and it happens fairly often. So you have to be prepared for that. Trying to time it, tricky. Now, I've got another story I'll get to. Real quick, if you'd like me to answer your questions on the program, you can send your questions to questions@PlanStrongerTV.com. Or if you'd just like more information about the program and what we do here, PlanStrongerTV.com is the website. Now, I want to get to this story because it's a personal story of mine. I can tell you firsthand that when things go bad, it is very difficult to respond in the moment. The analogy is cycling. I like to ride my bike. I go out in the morning early, out on the roads, and when it's quiet and not a lot of traffic, and I go for a nice long bike ride. It's my time to relax and have a little time to myself, think through things, what I might talk about on television. So I was going one morning, and I was on the side of the road, plenty of easement, no issues, headed out, cool, comfortable, all good. Well, I hit a little sand, and then I recovered. I didn't lose my balance initially, but then I hit some more sand, and then when I did that, my front tire slid off the front of the road. And then I hit some more sand, but this sand was thick, and it was soft. My front tire stopped. I didn't, and I was launched in the air. And of course, it feels like slow motion, but I had my helmet on. If I hadn't had my helmet on, there would not have been time to put it on. So thankfully, the helmet was on because my head hit the pavement. I was still enough on the easement. My head hit the pavement. And when the doctor goes, oh, you did knock your head pretty good. I'm fine, I was okay. But that's why you wear a helmet. So my point is, you put your helmet on before, because in the moment, there's just not time. I hope you've enjoyed the program. Heed the lessons and apply them to your situation. Thanks for being with me.